Okay, that's great. Thank you. And hello, everybody. Welcome to today's webinar. My name's Adrian Boothie. I'm the head of trading here at TrendSignal. And today we're going to be talking about how to spread bet online. So we're going to be going back to the basics. So some of you have never traded before, or maybe you've traded for a bit, but you're not so sure about a few things about how it all works and some of the advantages of spread betting and so on, then definitely stay tuned. There's going to be some really good stuff in today's session to get you hopefully a lot more informed about what it all is and how to go about it in the best way. Okay, so this is a live session. I am talking right now and you can get involved. Okay, so whilst we might be streaming on YouTube and on Facebook and on my Twitter profile and a couple other places, GoToWebinar users are able to chat and interact with us. So if you're watching us on GoToWebinar, then you can type a message in. Can you do that for me now, please? Just so I know it's all working loud and clear for you. Now, if you're on GoToWebinar, it's going to look a little bit something like this. It might be a bit different depending on the device that you are on, but smartphones and tablets, it's going to look a little bit like this on the right-hand side, and you'll see the question mark at the bottom. Hit that, and then you can type in. It brings up the keyboard in its own weird and magical way that it does. Alternatively, if you're on a laptop or desktop computer, it might look a little bit like this as well. So you can just see there, hit the orange button, allow you to type into the questions box, or just look for a speech bubble or a question mark or something like that somewhere on the screen. If everyone can type something into the question section or the chat section, that'd be fantastic, just so I know we're all operational and everybody knows what to do, so that most importantly, you know how to interact through today's session and ask any questions if you need to. So hi there, Peter. Hi there, Star. Hello there, Dwayne. Hello, Robert. Hello, Jonathan. Margaret. Hello to you. Let's get on with it then, shall we? So spread betting online, how to do it. Like I said, we're going to go through all sorts of stuff today. But before I do, I just want to go through a bit of a boring disclaimer, really. Don't panic. I'm not going to read it all, but just the first paragraph, really. Spread bets and CFDs are complex instruments that come with a high risk of losing money rapidly due to leverage. You should consider whether you understand how spread bets and CFDs work and whether you can afford to take the high risk of losing your money. Past performance is not a reliable indicator of future results. Okay, that was fun, wasn't it? Okay, so what we're going to do is go through these bits today. So how to spread bet online. We can talk about types of accounts, markets to trade, pips versus points versus pence, leverage. I want to go through all of these different topics today. Okay, so the good thing is a lot of them can be sort of bundled together. A lot of them can be wrapped up as we go through practical examples. Okay, so I'm not going to be sort of death by PowerPoint today. We're going to be going through some good stuff. But is any of these concepts you're not so sure about, let me know. In fact, why don't you do that now? Let me know in the questions box. If any of these things in here you're thinking, what the hell does that mean? Why don't you let me know, please, in that questions box, and then we can start to get straight into it. Certainly, what I want to go through today is an idea, an overview, if you like, to begin with, for the different markets that are available to trade. Now, one of the great things about spread betting is that it is a sort of a one-stop shop for a lot of different markets within a platform. So back in the day, the old days, it was a lot more limited, and then it became really open, then it became more limited again, and now it's really open in terms of the different markets that are available. So one of the great things about spread betting is the ability to trade multiple different asset classes all from within one platform. Okay, it depends on the broker you're using. Some brokers offer more products or instruments than others. But certainly modern platforms can offer quite a lot of choice, whether that's Forex, foreign exchange currencies, whether it's stock indices, whether it's the underlying stocks and shares themselves, or whether it's commodities or even bonds and interest rate products, which are not that popular when it comes to retail traders. Now, one of the things that you're going to get with spread betting is good market choice, good low trade size, and also the ability to trade with margin. Okay, now we're going to talk about margin a little bit later on, or with leverage. We'll talk about that. And then the margin depends on the type of instrument that you're looking to trade, or the category of instrument you're looking to trade. But effectively, this is buying power. But like I said, the good thing is it gives us plenty of choice, and we can start to trade, obviously, the more main or more popular products. And we can go much more further afield with that as well, with modern brokers too. But I think that sort of brings us to what the differences are between share dealing, CFDs, and spread bets. Can I get everyone in the chat box, please, or the questions box, please, to let me know what type of trading account you've had before? So, or how have you traded before, if not at all? If you've never traded before, just type never in the questions box. If you've traded shares before, you can perhaps put an S. If you've done CFDs, then perhaps put CFD. And if you've done a spread bet, why don't you just put SB in there? Or it's going to be none. Okay, so if everyone could do that for me now, just so I've got an idea about where you guys are at. Have you traded shares before? Type S. CFDs, type CFD. SB for spread bet, and then none for never traded or never. Don't mind really which. That would be really helpful. Okay, so Stephen, for example, has never traded before, nor has Margaret, nor has Robert, actually. So there's quite a few brand new traders. Dwayne's traded options and futures before as well. Okay. You're going to find there's a lot of similarities between futures and the way you trade as a spread bet or a CFD, actually. Shares for Malcolm. Okay. I'm going to start off with just a little appraisal of if we're going to be share dealing, and then we can sort of move on to a little bit as well. Okay. Now, the thing about shares is typically if you want to trade shares, let's say you wanted to buy some Vodafone shares, then what you would need to do is if you wanted to buy £1,000 worth of Vodafone shares, you would need £1,000 in your account plus whatever those costs would be. So commissions, stamp duty, that sort of thing. So what that means is that the margin or the capital requirement to trade those shares is 100%. Okay, so if you want to buy £1,000 worth, you need £1,000 on your account. So if the market goes up 1%, then you'd make £10, basically, simple as that. CFDs and spread bets are different. You don't need as much capital on your account to do this. So you have something called margin or leverage available. And I think when a lot of people hear the word leverage, they think, oh my God, that's really scary. I'm going to tell you why it's not so scary in just a second. Okay, but basically, you can have different buying power or deposits required for different types of markets. So, for example, within the European Union, if you wanted to trade, and the UK now as is, if you wanted to trade Forex, you don't need 100% of your capital on the account to trade that notional value. You need a percentage of it. For Forex, it's 3.3%, 5% for indices, 20% for stocks. What that basically means is if I wanted to trade shares as a spread bet, if I want to do that same £1,000 value, notional value, I need £1,000 on my shares account. But as a spread bet, I'd only need 20% of that, a fifth of that. So to do the same, the equivalent value, I would only need £200 on my account. My broker then gives me the buying power of £1,000 worth with my £200. Now, why is he doing that? He's doing that because actually the day-to-day risk on a stock is not to fall to zero. Typically, a more realistic, big, horrible fall is going to be more like 10 to 20%. So what a broker does is it looks at, and what a regulator does, is it looks at the typical horrible worst case kind of move or typical worst case move that might well happen if the market goes the wrong way. And then your margin requirement is really based on that level. So if, for example, a stock with some horrible data like a profits warning might fall 20%, well, that's why the number is set to about 20%. That is what the regulator deems to be an appropriate amount of money. So what that means is with £200 on your account, you could buy £1,000 worth of Vodafone. Now, that doesn't necessarily mean that you should, by the way, because what you're doing is you're trading sort of with only £200, £1,000. So, of course, if that market goes down 20%, you're going to lose all of your capital. However, you don't have to trade in that way. The way I like to look at leverage is that, yes, you might be able to buy more stocks or more size of stocks, because actually with £1,000 in your spread betting account, you could actually buy £5,000 worth of Vodafone shares. And with that comes inherent risk. Suddenly you're buying times the amount that you might do within your share dealing platform, which means potentially 5 times the risk, which is obviously a bit crazy. The thing with it is, and what spread bettors I believe should do, is actually look to diversify. Maybe instead of trade loading up all into one stock, you could actually trade 3 or 4 different stocks or 5 different stocks. So that allows you to diversify the risk instead of going all in on one particular trade. The point is, though, that spread betting allows you additional buying power, which is really based on the inherent volatility of that market. So the bigger the margin requirement as you look down these percentages is really based on the typical risk, or the bigger the moves you might experience on those particular markets. Okay, so when you think about leverage, what a lot of people do is think, well, that sounds still quite scary. I've never done anything like that before. But actually, we have. Most of us in this session probably are already using leverage in some way. You just may not have really thought about it like that. Anyone who's bought a house before, assuming they've had a mortgage, has used leverage. Okay, it's the same principle that if you're going to buy a house, let's say you're buying a house for 100,000, the deposit that is typically required, let's say that's 10%, will be 10,000. Think of it like this. Okay, so your deposit is 10%, and if the price goes up but to 110,000, you'll actually end up doubling the capital that you've employed. You'll have made a 10% return, but actually you'll have made a 100% return on the capital used. So that's actually leverage, because what you're doing is you're putting 10,000 into the house and you are borrowing the outstanding 90,000. This is margin trading in its most known form, because most people do that with a mortgage when they buy their house. Okay, so it is something that most people are used to. And why are we okay with it? Why do we have to put a deposit down? Because the house might fall. So there needs to be some protection for the bank who's lending you the money, just like there needs to be some protection for the broker who's doing it and offering you the same sort of flexibility, if you like, and buying power that your mortgage broker does. Okay, does this all make sense so far, everybody? If you've never traded derivatives before, let me know. Does this make sense? Give us a quick yes or a no. I think it's always a fascinating thing. A lot of people say that leverage is a really risky. Spread betting is risky. It's no riskier than trading shares. It's no riskier than anything else. What creates risk is bad strategy or bad risk management. In itself, they're no riskier than anything else. The leverage, if treated the wrong way, is the thing that creates the additional risk. Okay, you buy £1,000 of Vodafone worth of Vodafone on a share dealing account. You buy £1,000 worth of Vodafone on a spread betting account. Your profit and loss is going to be basically the same. In fact, it's probably going to be more profitable as a spread bet because the dealing costs and tax are typically lower. So actually what ends up happening is it's probably a better way to trade as a spread bet, but you also have the added benefit of being able to trade with leverage. Okay. Is it the same thing as spread trading? Well, people use spread trading as different. Spread trading is really something different, to be honest with you. But some brokers like to use the word spread trading because it removes the betting connotation of the term spread betting. But spread trading is actually a little bit different, a different concept, to be honest with you. Okay. All right. So that's leverage. That gives us an idea about that. The other thing about a share dealing account is you can typically only go long. What does that mean? You're long of the stock means you buy the stock hoping that the price can go up, and you only really make money from the price going up. Okay, maybe dividends, but in other words, you're looking to make money from rising prices. Trading, and with CFDs and spread bets, you're speculating on direction change. So if you go long first, you can make money on prices rising. If you think this market is going to fall, you can go short, and you can make money on prices falling. Now, you can do short trading on the share dealing accounts. It's just that most brokers don't allow you to do it. Okay, but it's relatively unusual. But you can do it very freely within a CFD or a spread bet account. Taxation. If you're trading UK shares or anything really, well, UK shares, it's liable to stamp duty. Okay, so stamp duty would be 0.5% of on the purchase side. So whenever you buy a UK stock within your share dealing account, you'll be charged 0.5%. It may not sound like a lot, but when you're trading actively, it doesn't half add up. And then you'll also be charged capital gains tax on any profits above a certain minimum amount of tax-free capital gain. Anyway, whatever it is, that is something that you do need to consider. So not all of the profits, depending on how much profits you make, will be kept by you. Similarly, with the CFD, spread betting, on the other hand, under current UK legislation, is tax-free. So there's no income tax to pay, no capital gains tax to pay on any of the profits that you make. Okay. One other thing that you'll sort of notice is that you can trade shares pretty much anywhere. CFDs, pretty much every country can trade CFDs, with the exception largely of retail traders in Belgium. I think the USA, you can't trade CFDs or spread bets there. They have different types of financial products that you can trade for leverage instead. But spread betting is predominantly a UK type of product. So if you live outside of the UK, you're more likely to trade these things as a CFD than you are as a spread bet, but they are broadly the same. The only real difference is just slightly different packaging. Okay, so what that does is gives us some certain advantages of a spread bet. Leverage, so we have increased buying power. Okay, so we only need to use a certain proportion of the capital in our account for a trade, which means that we can A, trade bigger size, which you may or may not want to do. And B, you can diversify, so you could trade more instruments to then balance your risk a little bit. Or actually C, what you can do is look to fund your account with a bit less in your account and then keep your other funds available in perhaps a high interest account or doing something else. So it allows you to use your capital more wisely by doing things as a spread bet. So you can go long and short, you can make money on rising or falling prices. Taxation wise, under current legislation, is 0, and it's predominantly a UK product. Okay. What else have we got here? What I want to do is take a look at, this is not going to be a crazy long event, by the way, and some of the things that I've got on here, we're going to be able to go through quite quickly when we start thinking about some trading examples. Okay, so what I want to do is go through some examples about how spread betting actually works. By the way, as I said, this will not be a particularly long webinar, but I just want to make sure that we go through the basics. And I'd rather do it practically rather than a different slide for each individual concept, because as I go through this, we're going to be able to understand what the different things actually mean. Okay. So one of the things we need to know is about the markets that we are going to trade. Now I've got an example of a particular trade for the pound against the US dollar, which can then give us an idea about the pips, the points, and the notional value of the trade that we're looking to do. Okay. So if you're trading the pound against the US dollar, most currency pairs will trade to the 4th decimal place. Okay, so that's the 0.0001. What on earth does that mean? So when you talk about what a pip is, or a percentage in price, or whatever it's supposed to mean, it doesn't really matter what it means, other than what actually it is, which is a movement or the tick value on a particular broker. So when you trade, let's say £1 per point, okay, the point is to the 4th decimal place on most currency pairs, unless it's a yen pair, a Japanese yen pair. What that basically means is if the market moves up or down by 0.0001, then you'll make or lose a pound. Okay. So this is important, and it's important to know what you're staking to, because it'll have an impact on your trade size. What you don't want to be doing is trading something 10 times the size you thought, because it's probably going to be a loss-making trade and hurt you very badly. Or you end up doing 1/10 of the size that you thought, which is always frustrating, because that ends up always being a winning trade when you make that mistake and you've only made 1/10 that you thought. So let's make sure we get that right. So let's have a look then at the price. So what I've done is I've just put the prices up here so you can see practically. So if you're going to trade pound dollar, these prices are way out, but it doesn't matter. So let's say this was trading at 139.78.3, okay? And then it's trading to 139.79.2. The first thing to think about is, well, there's a sell price and there is a buy price. Why is there two different prices, and what is the difference between them? First of all, the difference between them is what is called the spread. This is the amount of price that the market has to move, or the difference between the sell and the buy price. Now, clearly, that amount of difference is how much the market needs to move in your favor before you're break even on the trade. Because if you were to buy it straight away at 79.2 and then sell it straight away at 78.3, you'll be selling it immediately for a 0.9 pip loss, which at a pounder point will be a 90 pence loss. Who on earth wants to be doing that? Clearly, the lower the spread, the smaller the amount a market has to move, or the price has to move, before you're in a break even or profitable position. So it's important to have one eye on dealing costs or spread. That's not to say that you must trade with the broker with the tightest spreads, or even you must trade with the markets that have the tightest spreads typically. It's about looking at your dealing costs relative to your objectives. So I don't mind trading a market with a 10-point spread as long as my target is can manage that 10-point spread, or can accommodate it, can absorb it. Okay, so why is there a difference between the buy and the sell price? Let's think about this as a marketplace, like an auction. There are people wanting to buy, there are people wanting to sell. And if they're wanting to buy and sell at the same price, well, frankly, they get matched together. Okay, so in which case they're no longer in the marketplace anymore because they bought their shares or they've sold their shares. That's it. So what you end up with is a selling price that is lower than the buying price. Now, the selling price is effectively made up of buyers. That's what the broker is. He's buying off you. So you can sell to him, the broker, at that particular price. Equally, if you're looking to buy this market, pound against the dollar, you want to buy pounds against the US dollar, then effectively your broker is going to be selling it to you. That's the price he is setting you. So 139.79.2, that's the price that he's quoting that you can buy at, that he will sell to you. Okay. So they always have to have a difference, because if they were the same price, then effectively the sellers and the buyers would be matched together. But you want that price to be as narrow, really, or as tight as possible. And in this case, in this example, 0.9 pips is pretty tight. So if you're going to go long on this market, and if you thought that pound against US dollar was going to go up, what you'd be doing is hitting the buy button. If you hit that buy button in this market section, this market order suggests that you want to go in at whatever the market price actually is. Okay, whatever it is now, which is at 139.79.2, that's the price you're wanting to buy at. Okay. Now, one of the things about it being what the pip is, often brokers will help you out in this regard. What you'll notice is that the font of the 79 and the 78, and I've marked that here as well, is slightly bigger than the font for the rest of that number. This is to give you a clue about what you are staking it to. So I moved from 78 to 79 to 80 to 81 to 82. The bold part of the number is demonstrated in bold because that is the point value. You'll notice there is a fractional point after there. We don't worry about that so much. Okay, so you're trading it typically to the larger font number, font size number. The reason you have a fractional bit in the price afterwards is really to help with quality of execution and speed of execution, basically. Okay, hopefully this is all making sense so far. It's difficult to sometimes explain some of this stuff because, sometimes as traders we know it so well that it's difficult sometimes to explain stuff without it being a little bit sort of confusing, really. But hopefully that makes some decent sense. Okay, so we know the spread, we know how the price kind of works, and obviously we know as well that we need this market to move up, all other things being equal, 0.9 pips before we break even on that trade, and that's fine. Let's have a little think about the trade size and the notional value. What is notional value? It's the actual value of the trade you're looking to do. So how do you work that out? Well, you take the number of pips that are in the price. So effectively, if I was going to buy at 139.79.2, it's 139.79.2. Okay, so just put a decimal point after the pip, basically, and then times it by the stake. So if I wanted to trade the number of pips, I just look at the price and put the decimal point after the big fonted bit, okay, big font size bit, that's where the decimal point will be, times it by the stake per point I want to do, and that gives me a notional value. Effectively, what this is saying is, by trading at £1 per point, oh god, That is the exact same trade size as buying £13,979 worth in this trade, notional value. Okay, obviously I divided £10 a point, then really I'll be looking at that being 139,000 and so on. Now, the good thing about leverage trading is, and particularly with currencies, they're not going to move huge amounts each day typically, so you can get decent leverage on it. Okay, so the leverage available, the margin rate or the multiplier on your buying power is relatively high on currencies. So you can trade at 30 to 1. Okay, which is 3.3%. So if you want to know how much capital you need in order to do a £13,979.20 position, you simply divide that number by 30. Okay, so there's the number, divide by 30, basically means if you wanted to do a pound per point of pound against the US dollar on your account at that price, you need £465 on your account. Okay. Now, usually a broker will actually put that into the platform there and just explain what it is. And most brokers will do that to make sure it's nice and clear. But that's basically it. The notional value is the pips times the number, all the pips that there are on the price, if you like, times by the stake, the trade size you want to do, which will give you a notional value. Divide it by 30 when it comes to foreign exchange, and then that will give you the margin that is required for you to open that trade. Everybody, does that make sense? Give us a quick yes or a no, please, again in the questions box. Now, I appreciate for some of you this might be quite straightforward, but I just want to make sure we're all okay. Now, just going back again, why is it set at 30 to 1? Why did the regulators set it at that level? Because really, if you think about what a market might do, how much it might move in a day, most currency pairs, a really big day is about a 1% move. Okay, so maybe a 1.5% move on a really big day. So what that is just a little bit of covering. What you don't want to be in is in a situation where the market moves a little bit and then the broker's calling you up to put more capital on your account because you're overexposed, or the broker's closing you out of the trade because you've gone totally all in and you've lost all your money in about 3 minutes. Nobody wants that. Okay, so the level is set to 30 to 1 on currencies because it gives plenty of wriggle room based on the risk in which this market is likely to move. Okay, or could move typically in a day. And you'll find that Forex doesn't move that much, right? In percentage terms, like I said, a 1% move is a pretty big move in a day. Whereas you take that to something like an oil, for example, that could move 3 or 4% in a day easy. You take a stock that could move 3 or 4, 5, 10% in a day easy. Do you see what I mean? So you have to, what the brokers will do and what the regulator leans on them to do is to margin according to the speed in which that market might typically move. Okay. Okie smoky. So let's have a look at another currency pair. This is going to be a little bit different. So most currencies, particularly when you're looking at US dollar, Canadian dollar, Australian dollar, New Zealand dollar, Swiss franc, euro, the pound, any crosses between these currencies will trade to the 4th decimal point. Okay, just like that pound dollar example before, the 4th decimal point. And the example you've got here could be the same for any of those examples. Okay, any of those markets. So it could be the same for Aussie Swiss, it could be the same for New Zealand Swiss, it could be the same for pound Australian dollar, doesn't matter. 4th decimal place. The yen pairs, by contrast, because there's so many yen to a euro or so many yen to a dollar, like 100 odd, the pricing has to be a little bit different. So what you'll find with a yen pair, so if you're seeing JPY in the currency, then usually the staking will be different. You'll notice instead of being 1 point something, it's 108 point something. 0.41. You'll notice that the 41 has a bigger font size. The 42 has a bigger font size, and so on. And that's because when you trade a JPY pair as a spread bet or a CFD or margin FX, you're typically trading it to the 2nd decimal place. Now, again, there is a fractional pricing in there, which we'll talk about why that is a different day maybe. But effectively, it's the 2nd decimal place there that creates the pip, that is the pip movement. So move from 41 to 42 to 43 to 44 is a pip. Okay. Now the price here is at 41.2 to 42. That is a 0.8 pip difference, which means the spread in this example is 0.8 pips, as demonstrated nicely on this deal ticket. Okay. So same basic premise as what we saw before. In terms of trade size, okay, so if I wanted to do £1 per point, which I've put in here, okay, so GBP per point, £1 per point, then it's going to be, my notional value is going to be the stake times by this, okay, so the 108.42. So let me just clear those scribblings off. So what's the price in pip terms? Let's get rid of the decimal point and put it in afterwards, after the raised font. So 108.42 times it by the stake per point, 1, basically means that this is a 10,842 position. Okay, and because we can trade that at 30 to 1, divide that by 30, and that gives you our notional value, which means that in order to do this trade, we would need £362 on our trading account. Okay, so it's relatively straightforward in that regard. And again, your broker should demonstrate that for you, but I think it's really important to understand why and what it is and so on. So rather than the broker telling you, oh, you need this amount of money, it's good if we know why we need that amount of money, what the calculation is based on, and so on. Okay. Fine. Hopefully that's all relatively straightforward. Now, different markets will have different pips points or notional value. I encourage you, with whoever your broker is, to check that. Okay. So one of the great things about all of this is that it can tell you what you're betting to. Bet per point is the 0.01. That is there. These are all safety measures. The height, the raised font, the notional value, the margin required. These are actually there as safety features to help you to make sure you're trading it in the size that you thought it was. So if you're sitting there thinking, I'm going to do, oh God, I put in 10 or I didn't know the decimal point was there or whatever, and you look at your margin requirements suddenly being £3,000 instead of 300, you know that there's something not quite right. Okay, so it should just give you a little bit of a red flag to help you to do it the right way. Okay, let's think about another example. So this is the FTSE 100. Okay, now don't worry, I'm not going to go through every single market, but with the FTSE 100, it's a stock market index, and these are good markets to trade. Stock indices, they're typically the most volatile, notwithstanding the FTSE certainly not being so. But things like the Dow, things like the DAX, the S&P 500, the Nasdaq, these are good markets to trade, good active markets that are really good for day trading, certainly, and good for swing trading as well. But the FTSE 100, very popular market in the UK for obvious reasons. It's a good market to trade because it has, typically a good tight spread. Okay. And we like the stock market, don't we, typically? So what you'll find is, in terms of trade size, again, what are you staking to? That most brokers will quote this to the full point. How do we know this? GBP per point is there, 1, the full number. Okay. And you'll also see the raised font here, 31 to 33. So that's what it is. The difference between 31 and 33 is 2. That is the spread. This broker has a 2-point spread on this market at present. Okay. And that means that effectively this price needs to rise by 2 points in order for me to be break even. So this probably needs to go to 69.33 to 69.35 before I'm break even, because I will buy at this price and I will sell at this price. So the tighter the spread, again, gives you a smaller amount the market has to move in order for you to be break even or into a profitable situation. Okay, but again, spread isn't everything, but it certainly helps if you've got a nice tight spread. So we're going to do this at £5 per point. So how does that work? Well, we take our price. Okay, we're trading it to the full number, if you like, not to any decimal point. So it's 6933. We're going to be buying it. 6933 times by the £5 per point that we're going to do. So the notional value be 6933 times by 5 is that number there. And because indices trade at 20 to 1, that is a 5% margin requirement. That's how much money, what percentage of this you need in your account to trade it. this amount divided by 20 or times by 5% or times by 0.05, whichever way you want to do it, gives the same result. So in order to do £5 a point on the FTSE 100, you need £1,733 on your account. Simple enough, I would like to think. Again, brokers are going to be different, so make sure you check your broker to know exactly what it is. Now, how can we make money on these particular trades? Well, obviously, if we're going to be looking to buy a particular market, we want it to go up in price. Why is it going to go up in price? Well, for various reasons, fundamental, reasons, and so on. But ultimately, that's what we want it to do. So let's go through an example of what that means in monetary terms and how we can actually make money on it. Now, what we use, the reasoning behind buying or when to buy or the reasons to buy is something else. Okay, we're not going to cover that in today's session, but it's more about the mechanics, about what happens if we buy and how much profit can we expect to make if the market goes up a certain amount. So let's go through a certain example here. So this is an example for the pound against US dollar, and we're going to buy £3 a point. Okay, so for every pip this market goes up, we're going to make £3, which also means for every pip it goes down, we're going to lose £3. Okay, that's the way it works. And remember, you can manage that risk with a stop loss and manage the objective with a target as well. But what we're basically looking at is at a price of 139.70. We're going to buy at the buy price, the right hand side price, the higher of the two prices. That's what we'll be buying at. Okay. So the notional value on that trade will simply be, notice what I've done here. Okay, I've got rid of the decimal point. Why? Because I want to show this in terms of its price. Whenever I look at things, I look at it in sort of its pip term rather than the actual 1.3970. I'll say 139.70 rather than 1.3970. Anyway, so effectively my notional value will be 3, my stake per point, times by the price gives me 41,900 notional value. Now the margin required on that is going to be divided by 30, is going to mean we need 1,397. Okay, it's a little bit different there, but anyway, just for rounding error or whatever. Okay, so the margin requirement is going to be 1,39704. Fine, that's how much money we need on the account. Now what we see is that the price starts to rise. So we bought it at 139.70.4. But we've now seen the market rise to 139.90. Okay, the price quoted is now 139.90 to 139.90.9. So 0.9 pip spread, which is nice and tight. But notice I'm going to be buying on the right hand price, and when it comes to sell, I'm going to be selling on the left-hand price, the sell price, the lower of the two prices. And when it's up at 139.90, I'm going to decide to sell and close that position. So the price has risen to 139.90. How much has it risen by? Well, let's subtract the entry price from the current price or the position and close at price at, and that gives me 19.6 pips. That is a 19.6 pip profit. Now remember, we did that at £3 per point, so to work out what our profit on that trade was, it is simply 19.6 pips times by £3 per pip gives us a £58.80 profit on that particular trade. Okay, and because we only needed a certain amount of capital on that trade, 1,397, that is the same as the equivalent of a 4.2% return on capital. So we only use, so £58.80 as a percentage of 1,397 is a 4.2% return on capital. So that's where spread betting can be really attractive, because we've actually only used, even though we bought £41,000 worth of the pound, we actually only used 1,397 in our account. So we had extra buying power to perhaps take on other positions if we wanted to, or keep some of our capital in a savings account if we wanted to as well. We'd have to use that entire capital unless we want to. The point basically is we can have a good accelerated amount of return on capital, but important to manage that risk and offset it by having the right stop loss in place, etc. Let's do one more example. We're going to do one of a loss-making trade. So I've got the same basic principle, same chart, same thing here. And again, we're going to do £3 a point. And this time though, instead of buying there, I'm going to be selling first. I want to speculate on prices falling. So I'm going to do a short trade. Okay, so this means that I'm going to sell something I don't even own yet. How on earth am I doing that? Well, I'm going to sell pounds and buy dollars. Okay, I'm still buying something. I'm buying dollars with my pounds effectively, is one way to think about it. But really, the best thing to do is just simply focus on direction. All we're interested in is the market falling. We think the market is more likely to fall. Therefore, we're going to do a short trade or hit the sell button first and then buy it back, hopefully at a lower price later on. So if we buy it back at a lower price later on, it'll be for a profit. If we buy it back at a higher price later on, it'll be for a loss. It's the same thing, but just the opposite as a buy trade. But of course, if we're going to take a sell trade, which of these are we going to hit first? Is it going to be the sell price? Is it going to be the buy price? Of course, it's going to be the sell price. So we're going to be selling it at 139.69 and a half. Okay, the notional value for that will work out in the same way. Times it by 3 gives us that value. The margin requirement is that value divided by 30. That's the margin requirement, or times it by 0.3333%. Sorry, 3.3333%, whatever it is you want to do. Let's say the price then rises again to 139.90. Oh God, that's going the wrong way, and it's gone the wrong way by what a few pips basically. So as it goes up, we can sell at this left-hand price, but now we're going to be buying at the right-hand price. So we're going to be looking to close out of that trade at 13990.9, which is a loss of 21.4 pips. 21.4 times by 3 pounds per point is a £64.20 loss. That's basically how it works. Okay, so all it is a question of hitting the sell price first if you want to take a short trade, and then you buy it back to close later on. Okay, again, everybody, is this all clear? Are we making sense? Give us a quick yes or no. It might be you're not too bothered about the overall notional value. Most of us are not really. What we're mostly interested in is what our monetary risk is on a trade and what our objective or target value or distance or profit could be on a trade as well. That's mostly what we concern ourselves with rather than the overall notional value. And of course, those things can be calculated quite easily by looking at your stop loss and looking at your target. Okay, so if you were going to go into a trade like this and you're brand new to it, yes, you can enter a trade now, and we'll do this another time when we go through order types and so on. But one of the things you can do is you can put in a limit order. In fact, why don't we do that now, just very, very quickly. If you're going to buy a market, say buy a market at X, okay, you want prices to go up, you don't want prices to go down. But equally, what you don't want to be doing is sitting there panicking about that particular trade, right? So what you want is some protection in there. And have protection, you can put in something called a stop loss. So let's say you bought at 100, okay, the price of it was 100, and you say, well, okay, it might go down. And what I don't want to be doing is sitting there panicking about it while I'm walking the dog or whatever. So what you want to do is be able to manage that risk. So if the price goes down to a certain level, and the way you think about this is like, at what price don't I want to be in this trade anymore? What price is, if it gets there, is the price now more likely to get worse than it is to get better? That's really what your stop loss should be, where it should be. When the likelihood of it getting worse is bigger than the likelihood of it improving and getting better. So let's say you set a stop loss at 95. Okay, so the price goes down to 95. That will trigger a stop loss order with your broker. If you set it with your broker, you put that in and you put the 95 price in and so on. That will then trigger a sell at that trade because you bought it to begin with. You then need to sell it to close out. That will then look to manage your risk. And as soon as the price hits that 95 level or below, it'll look to get you out at the first available price for you. Okay, so it's a good way of looking to manage your risk. You can do the similar thing with a take profit level, take profit, target price, whatever. So if the price goes up to say 105, you might want to be looking to take profits up at that level. You may be trading a particular strategy where you're going to be in a trade for a little while. You don't want to be sitting there staring at it all the time. Or the market could just whip up there so quickly and come all the way back down again that actually to do it with the naked eye can be a little bit tricky. So actually sometimes it's quite a good thing to actually just set an order with your broker platform to close you out of the trade when appropriate. So that's certainly something to absolutely consider, putting a take profit level in so that even if you're out walking the dog or asleep or whatever, if the price gets up to your level, the broker can look to close you out of that trade. So it's these things that really help us to manage the trade. Don't be put off by notional value. The most important thing really is the risk and how far you think that the market might look to move against you. Okay. But stop losses are well worth it. And in fact, I would go as far as to say that you shouldn't trade without a stop loss. Because it's just that worst case scenario. Now, I'm not saying that you have to put in a stop loss in before you place the trade. Certainly, I know there's a couple of people who are going through our dynamic trader course. It's probably a better idea to put the trade on first and then add your stop loss immediately after, just so there's less clicking and less faffing about before the trade, because you don't want the market to move too quickly and then you've missed your opportunity. So if you're a swing trader, you have more time. It's usually a good idea to set up your stop loss and target with your trade, place it so it's all nice and done in one deal ticket. If you're trading or day trading, looking at much shorter term moves, sometimes a good idea is to place the trade, then go into your trade with your broker, and then add a stop loss and target afterwards. That's often a good thing. Okay. That's mostly it actually today. And I know this was kind of quick, but I think actually what we've really managed to do is cover quite a lot of this in just a few examples, believe it or not. We've kind of gone through the types of accounts, markets to trade, pips, points, leverage, long or short, out of hours trading. We haven't really talked about that, but spread betting can be useful with that. The ability to trade markets out of hours where the broker sets the price. Certain markets are only traded within certain hours, where spread betting, because you're trading with a market maker, they can actually create a price for you outside of normal market hours, which can be really advantageous actually. Hedging portfolios, you can use it that, because don't forget, if you're long stocks, then actually, and you don't want to close that out and lock in a capital gain, sometimes the ability to put in a short on a stock to manage your risk or manage your portfolio slipping back can be a really good thing. One of the main reasons that CFDs were established in the first place was to help traders and investors to hedge their portfolio. Flexible trade sizing, very simple trade sizing as well. A lot of brokers now, well, actually not a lot of brokers, actually some brokers now will allow you to trade from just 10 pence per point. That means if you had a £100 100 point stop loss on the trade and you're risking 10 pence per point, that's a £10 risk on the trade. That's good. It's nice and light. It means even if you're quite new to this, you don't have to risk lots and lots of money on a particular trading opportunity. One currency account, so that's also useful as well, so we're not having to worry about currency risk with spread betting. So if you're going to trade a US stock on a spread betting account, for example, you trade it at pounds per point, which means you're not worried about the dollar movement against the pounds you have in your account. So you're not worried about currency risk, which is good. No commissions, which is cool. There is overnight funding, so the longer you hold a trade overnight, the more it will cost you, just like it will a mortgage. But the good news is that those funding rates are pretty low. So it takes a long while, by the way, about 2 months before the cost of the overnight funding overtakes the stamp duty cost. So there are definite advantages really with that. All right. I think that's pretty much it, really. I just wanted to go through a few basics with you guys today. Now, if you want to know a little bit more about strategy, then you can actually book a live webinar that we do these quite regularly, actually. If you go to trend-signal.com and then click on the book free webinar button at the top there, you can actually book to come into one of our events where we'll teach you some trading strategy. So whilst we've gone through some of the basics, the practicalities, what we haven't done today is talk to you about how we can identify trades, or what types of trades, what type of action we might want to take, i.e. which markets should we buy now and why should we be buying them and how should we go about doing it. We haven't talked about that at all. All we've talked about is what you might do with a broker account, but it's that spark of information. It's a bit like, well, I've got a betting account with Ladbrokes now, that's fine, and now to place a bet, but which football team's going to win? It's about that. And this is the same thing. So this is about teaching you something that could help you to identify high probability trade setups that can help you trade with a lot more consistency and also simplicity as well. So don't have a look at that, trend-signal.com. This is our website there, and then you can book a free place on one of our next webinars there as well. Otherwise, everybody, that's pretty much it for me. I know that if you've been experienced in trading for a little while, that was probably kind of basic, but you know what? Everyone has to start somewhere, and there's no shame in that. There's nothing wrong with it. We all did it somewhere, and hopefully that's been kind of useful today. Any feedback, any topics you're not so sure about, anything you'd like me to cover off in future sessions, questions, please do let me know. Just type those details into the questions box. But hopefully you've had a good session. Give me some feedback, please, guys, and have a wonderful week's trading, won't you? Bye-bye for now.